Good afternoon, everyone. I wanted to stop and give you some information on lending, and I've invited Aaron Chapman to help me answer some questions. Aaron, please tell us who you are and what you do.
Thank you, Missy. As you said, Aaron Chapman. It's kind of hard to not for a person not to repeat that, right? So I'm with Security National Mortgage Company. Been doing this since 1997, and been working mostly with real estate investors since about 2003, and just focused there. And for the last however many years that is, we have gone from just doing 100 plus transactions a year to over 700 transactions a year for real estate investors, and focusing on the business part of it, not just getting loans done. Loan is one thing that we do. That's what breads our table, but it's the business mindsets, the business strategies. It's helping the real estate investor to wrap their head around the fact that they are a business owner. And every time they acquire a property, that is a small business of itself, and that the team is paramount. Now, the loan will get done, but if you don't have the right team, to one, boots on the ground like Missy and team who are running your business as far as the regional operations division, then ourselves, myself and my team as your trusted advisors at your board table, give you the best data to help you make decisions about your business. And now today with the environment, what it is, you need that. You need that advice. You need the right people on board.
I absolutely agree. And Aaron is one of our preferred providers, by the way, for loan servicing. Can you tell me about what's going on in the industry today? Have lending qualifications changed for real estate investors? I know they have for homeowners, but is that the same with you or no?
Well, we're starting to see some change in the sense that we're going back to some old retro type guidelines. It's making us take a little bit more of a cautious approach to things. It's not changing so dramatically that we can't, continue to keep doing business that we do, because this was stuff we were doing 3, 4, 5 years ago. So it's not something we're unfamiliar with. We were still doing a lot of transactions for real estate investors back then. So it's going to be little nuances we have to adjust to. The main thing that has changed here is the landscape of lending in the world of how the loans start getting serviced. So what used to be, you would close a loan, and then a month or two later, they're going to get a letter from somebody else saying, you now owe us a payment, right? The loan has been sold. I always get that question. Are you a direct lender? Are you going to sell my loan? Yes, we are a direct lender. Yes, we do sell directly to Fannie and Freddie, and we service our own. But what has happened with that is that the individuals who are buying that servicing right, these massive companies that had all this ability to service loans and literally keep track of all those payments and disperse them properly, they used to get to a point where they would purchase every, let's say $100,000 loan, they buy it for 1% to 1.5% of the loan amount. That's $1,000 to $1,500 to buy the servicing rights. And then what they do is they collect those payments. They take a very small piece of it. That small piece would equal to about $300 per year per $100,000 in loan. Think about that. They pay $1,000 to $1,500, and it takes them a year collecting your payments just to make $300. So 4 years is what it takes for them to break even. Well, with the rate situation that's gone on recently, and with the Fed injecting capital into the mortgage-backed securities to bring the rates down to stimulate the economy, it's not the federal fund rate. That 0% had nothing to do with interest rates. It's not the 10-year. The 10-year treasury has nothing to do with interest rates. It's the mortgage-backed security. Go to mortgagenewsdaily.com. You can read about that. So mortgagenewsdaily.com/MBS, mortgage-backed security. Well, you can maybe able to post that up later. So that will tell you about the mortgage-backed security. Also, watch the movie The Big Short. So what they did was the Fed started putting a bunch of capital in there to bring the rates down. What did that do? People wanted to refi, right? A lot of people wanted to refi. Well, if you got a loan in the last 1, 2, 3 years and you refinance that loan, what had happened to the servicer who paid that $1,000 to $1,500 and had overhead and had technology costs and had taxes and had insurance costs? They lost money. Billions were getting lost overnight as a result of that. So they had to punch the rates up. And not only punch the rates up, they punched the costs up a little bit. So although the whole world is saying rates are an all-time low, they kind of are, but costs are actually being involved now, because the people who are going to service those loans are saying, listen, we can't take your loans because we're getting hosed. So we'll take them if you either give them to us or pay us a premium to take them. So now us on the front line are going to have to pay to be sure your loan gets serviced. So that gets passed on to you. It used to be we used that to keep the rates lower. So just know across the board, our industry is changing on that side. Just a little bit, not a ton. But when we get that opportunity to talk about it, because of tax benefits, because of inflation, it's not that big a deal, guys. Really don't let that push you off of your goal of building your real estate investment business.
It's still a good time to invest.
It's always a great time to invest. In fact, in reality, it's a better time to invest, guys. Think about this. We're living in an environment where people have to work from home. These people are working from home, the individuals, they're forced to work from home and have their kids at home, and they're cooped up in an apartment. What do you think they're thinking right now? Boy, they wish they had a freaking yard, because they can't use the common area because everybody else's kid is out there, right?
That's true.
So they're going insane inside their 700 square or maybe 500 square foot 2-bedroom apartment, right? They can't wait till it opens up and they can rent a house. If you're not buying inventory right now, you're screwing yourself at an opportunity when those people get to go looking for houses.
That's true. There's a lot going on with the government mandating how we collect rent and how we pay our mortgage with the COVID-19 pandemic. I know that we're, as a property manager, if a mortgage is backed by Fannie Mae, Freddie Mac, or HUD, not permitted to evict that tenant for 120 days, which causes a hardship on the owners that have those loans. What is the bank's response or the lender's response to that? Are there forbearance agreements, or how does that work?
So there are some forbearance options that are being published. Now, the first one that came out, the CARES Act, had to do with federally originated loans, basically. That's FHA, VA, and USDA, the owner-occupied, really low-down deals. Fannie Mae and Freddie Mac are GSEs, government-sponsored entities, so they don't fall directly under the CARES Act. They get to create their own. So they're creating something very similar. So the directives are coming out, but they're changing all the time because they're having to react very, very quickly, right? So what happens is when you have knee-jerk reactions, you don't understand the consequences of things. Mm-hmm. Kind of like what the Fed did with pushing billions of dollars into the mortgage-backed securities. Now they realize they're crippling the mortgage industry. Now they're adapting some of the process. So what we tell everybody is the best advice we can give is there's an 800 number on your statement, or when you log into your mortgage account online, look up the contact us and reach out to them. Talk to them about what the options are. Now, those options that exist, this forbearance, if you will, I've heard it go, they'll do 2 months, 3 months, 4 months. Let's talk about what forbearance is. That's meaning they're going to withhold collecting payments from you if you are approved for a forbearance. That's not a freebie. They're just not going to collect. Let's say it's 4 months, and let's say your payment's $1,000 a month. You will not make a payment for 4 months. That equals $4,000 that you get to avoid having to send checks in on. But month number 5, according to all the forbearance information I have personally seen, you get to write a check for $5,000. That's a lot. I would much rather send $1,000 a month when it's kind of hard than $5,000 when I know damn well it's going to be very hard. It's always hard to send $5,000, even when you've got plenty of money coming in. I don't like writing $5,000 checks, but no, that's the end result. Many people have told me that they've called the customer service department and says, "Oh, from what we understand, you can put it on the tail end." Guys, to put it on the tail end means you have to go through a process of a modification. And the problem with the modification process, I personally went through that myself in 2008. I was able to go through the modification because I was in a motorcycle accident that put me in a wheelchair. I was at a $1.7 million in medical debt just in the first week in the hospital. It totaled out almost $3 million. That was easy for me to go through modification. I gave them a fax of one paper. They were good, right? You get a $1.7 million medical bill. But if you're going to go through a modification, you must prove financial hardship. You must go through a process to show, I don't have the financial wherewithal to catch this up. I am sorry. So here's all my proof. If you've proven that, you've now locked yourself up for a while. I'm not sure how long, 1, 2, maybe 3 years, to be able to qualify for financing again for another investment property, because you have proven you're not financially solvent to pay the bills you have. Why would they give you more bills, right? Why would they put you in a position of more expense? So think about that in advance. Here's how I look at it. This is just Aaron Chapman's idea. You look at it however you really want to. The forbearance to me is the enemy is at the gate and I have one bullet left on my gun. It's for this, right? So you don't have to deal with whatever's going to happen there. That's what forbearance is for. This is not some opportunity to, hey, I'll just fill out the paperwork, save 4 months worth of payments and build up some reserves. That's not what it's designed for, guys. It really isn't. I've heard some people call me up, say, hey, we're going to do this, me and my partner, and I'm going to bust your balls a little bit here on that one. I don't think it's a wise move, because anytime you take advantage of a program that's designed to help people, to try and take advantage of it in the background, it always bites you in the ass. I've never seen it not bite somebody in the ass in that respect. So be cautious how you're going about it. If you need forbearance, you need it. I get it. But if you're taking it just because it's out there, you're putting yourself at risk.
Absolutely. And then that modification hits your credit report and stays there and keeps you from buying more properties in the future.
Yes, and I don't think the forbearance itself will hit it, but I believe that if you went into forbearance, let's say they've got a contract with you and they said, hey, I'm going to go on forbearance on these other 4 or 5 I've got, and they're waiting for a rehab to be complete here with you, Missy. Well, then we do an update on their mortgages, because we have to. We don't re-pull credit. We do what's called a credit supplement. We reach out to the mortgage companies, find out, be sure everything's current on their mortgage. And if forbearance comes up, I don't know how they're going to say it, if they're going to talk about it or not. I'm spitballing here. But if it comes up, then we have to look at this. Okay, if we got a forbearance happening here, can we legally put you into another transaction? So think about those things as you're considering forbearance, especially if you're trying to continue expanding your business. And if you're worried about things, because I've heard of some people taking their cash flow and they're spending that on personal stuff. I've heard of them using the cash flow to get their company Tesla, things like that. Guys, that's wrong. You shouldn't be doing that with your cash flow. You should build your reserves up for your business, making that for expansion of your real estate investment business. That shouldn't be going to you. You're not retired. You still have a job that's paying your bills. In the corporate world, that's honestly called embezzlement. So if you're taking your business revenue and put it in your pocket for goofing off, or vacation, toys, or jerking off in any other respect, you need to rethink your business thought process. Now is the time to understand what the ramifications are for not treating it like a business. And those of you just getting starting into it, you're coming in at a great time, guys. I think this is going to be an awesome time for the real estate market, and you get to learn from those people who made mistakes. There's a old saying I like to say a lot: good judgment comes from experience, and experience comes from bad judgment. We get to see a lot of people's judgment at work right now, and
Yes.
we get to go through it without having to go through the experience of making the bad judgment.
Awesome. Aaron, you are always colorful and educational, and tell us like it really is. Absolutely real.
You and I absolutely have no time for sugarcoating this. This is some brutal stuff that people are stepping into. And if you and I tiptoed around the issue, we'd be doing everybody a disservice. Guys, we're not, as you can see, I'm not your standard tie wearing, mortgage guy. No suit, no tie for this mortgage guy. I'm here to give it to you straight, give it to you fast, and give it to you as honest as I can, and in a way that you're not going to forget, because this can cause you a lot of grief. And and one thing that I like to talk a lot about, and I'll just hit on it real quick if you're okay with, is
Yes.
I like to ask people who made the most money during the gold rush. I'm going to ask you that, Missy.
I don't have a clue. Probably not the guys panning for gold.
No, it was the guys who sold the picks and shovels, right?
Yeah, probably.
So that's you and me selling picks and shovels here. But the difference is we have a earnest desire that everybody who buys a pick and shovel from us is able to achieve finding the gold. We want to direct you there. We want to walk you through the process. We want to give you the information we get from others who struck gold. And the reason that is because when you become successful, we become successful as a result. If they find that big vein of gold that we've helped them get to and we've done our job, not only do they need another pick and a shovel, they probably need a truck or a few of them, some heavy equipment, a smelter, a mill. They'll probably need a damn train. If they need all that, they come to us. So our interest in ourselves can be set aside for the interest of those who we service, because if we take care of them, we're just taken care of as a result. So guys, my passion, my anger, my frustration, my colored conversation has to do with, I want you to succeed so damn bad that I'm going to scream at you and possibly punch you in the utensil if you're not doing right by yourself.
All right, Aaron. Thank you so much for joining me today. I know our investors are going to gain a lot from this conversation, and I really appreciate you helping us out. Have a great weekend.
Thank you for letting me on. I always appreciate you and love working with you guys.
Thank you. Have a good day.